For them, a 10%, 11%. That's what the platform is able to do, because the lenders are okay to give that kind of rate to a solid borrower of that kind. But these would be solid guys, working with good companies, living in a very stable place, family, all that. So it's all the loans which gets 100% funded, is a loan agreement which happens. Now, once the profile is made live on the platform, the lenders, all of them can see. Just like Uber, if you want to kind of book a cab, you'll exactly see the information, about that particular person who's coming to pick you up. His number, his name, his data, all of that you see, right? You still have a choice there to cancel that guy or not. So that's exactly what it gives you. It gives you a very detailed information, and you can decide whether to pick the guy or to drop the guy. If you decide to pick, then once all of them have picked, 100% loan gets done. Then the loan agreement which gets initiated. Okay, so this is something that I need to spend a little time on. Now, the money that you move, or the money that you move from your bank account, it moves to another bank account, which is an escrow account. Okay. This is an escrow account, which is the parent escrow account is the organization's escrow account, and under this parent escrow account are multiple accounts of lenders. So your money moves from your personal account to your escrow account under this umbrella account. Okay, and this is where your money sits if you have to trade on the platform. And from this money you pick borrowers. Okay, and once you've decided to pick a borrower. Once only the 100% gets funded, or 75% and above gets funded, this money moves to the borrower. Otherwise, it does not move to the borrower. Okay? So it stays and it kind of rolls back to your escrow account. So that's the way it happens. Now, why this is important to understand is because this escrow account is not managed by us. It is managed by a trustee. Okay? So there has been a precedence in the past where banks and organizations have got together within the escrow account and swindled money. Okay, we're seeing that some of these cases coming up now in the real estate space. Okay, so RBI was very, very clear that this time they're going to put it out something which has a third party managing it. So the money that a lender wants to move to a particular borrower, I take that information and give it to the trustee. Trustee is the one who instructs the bank, and then the money moves. Otherwise, the money does not move. So basically. And they are subject to audit. They are subject to anything. They are very powerful position in the organization setup, at least in the peer-to-peer lending organization setup. They can shut your shop next day. Tomorrow they can shut your shop. They'll just stop instructing the bank to lend money. That's it. So it's so powerful. Now, how does it help the end customer? It helps the end customer. Because the money is locked in this escrow account, even if we don't exist tomorrow, let's say, this money is not going anywhere. Okay, I can't use this money for my expenses. I can't even take revenue out of that money. So my revenue account is separate. The money that I withdraw from the lenders is completely separate than what this lending money is. You can't touch. So if there's unutilized money, it lies in that escrow account only. I can't withdraw that money. Okay. I don't have any checkbook. I just have the viewing rights, for this. So they have built a very beautiful system. So all the peer-to-peer lending companies are supposed to kind of make use of this structure to kind of lend and borrow money. Okay. So all the borrowers are insured. I talked about this. Collection is through NAC. All collection happens. 100% of collection happens through NAC. We don't do any physical check drop and collection. So all of it happens through NAC. We do keep copies of physical check, and that is for some other reason. We use it for check bounce and to do section 138. NAC is the digital form of collecting money. Okay, system level rules and risk mitigations is interesting. Rule number 1 is fractionalization. Fractionalization means that if you are a lender on the platform and you have 1 lakh rupees to invest, your 1 lakh rupees, and I am a borrower on the platform and I need 1 lakh rupees. So your 1 lakh rupees does not come to me straight up. Okay, you give me just $500, and there are hundreds of lenders who give me 500, or 200 lenders will give me $500, and my 1 lakh rupees happens. So that's the way it works. So that's the principle banks also use. So banks do not lend the entire money to one guy, right? So they distribute to a large number of people. Their corpus is large, much, much larger than, so what we've done is that we've used technology to kind of make that really small. So you as a lender with 50 lakh rupees, you can pick up large number of borrowers with 1,000 rupees, 500 rupees, 2,000 rupees, splits. You can pick up large number. That's how it becomes stable. So that's the rule number one. So rule number two is distribution. This is even bigger a risk than fractionalization, is what I believe. You should not be concentrated or focused in one particular state or a city, because if that city undergoes something, your money would be at risk. If the borrowers decide not to pay in that city, some neta or abhineta comes and say that kal se jo hai loan maaf hai aapke liye, they'll stop paying you. So these things happen, in real. So just to kind of mitigate that, it's important to kind of spread it out to a large number of cities. It helps. So banks also do it. If you look at bank structure, within a city they'll have different branches. Why? Even if one part of the city gets disturbed, the other branches are active and going. Okay? So that's the reason the branch structure works. So similarly, distribution in large number of cities makes a lot of sense. So distribution is very, very important. Third is different types of loan products. So we have a whole lot of business loans, salaried, students, LOC, daily loans, weekend loans. We have a whole lot of them. We have added a few more types of loans in this. All of them are unsecured, but there are different types. So how it works is that different types of loans have different types of risk associated with it. It has different structures associated with it. It has different kind of repayments and all that. So lenders like that as a variety. Even banks have different kinds of types of loans. So there's a credit card, there's a home loan, there's a car loan, there's a personal loan, there's a LOP. So the different kinds of loans they have. Some are secured, some are unsecured. The idea is to have different kinds of loan structure. They have different rate of interest for different kinds of loans. So that's the way you have to build the portfolio. Okay, which means that you have to invest small amount of money in large number of borrowers to make money out of this. It's very, very simple. And anybody, the data suggests we've been operating in the last 6 years. Anybody who's invested more than 5 lakh rupees on my platform, not a single guy has lost money. Not a single guy. All of them have made money. That's what the data says. Okay, unless earlier what used to happen, it was free for people to kind of invest anywhere they feel like. So people used to get emotional about it. Okay. So the various trends, came about during that time. मैं बनिए को पैसे दूंगा, बनिया पैसा नहीं मारते हैं, and they build a portfolio on बनिया. If the underwriting model was so simple, we wouldn't have spent so much of time, energy, money. Okay, but at scale these things don't operate. That's the problem. बनिया भी पैसा मार देते हैं कभी-कभी. So similarly, there was this notion about women are better borrowers than men. Okay, a lot of people kind of create the portfolio with women borrowers. Because they had some preconceived notion about, it goes, in the microfinance, it goes to the women, it's very less default there, all of that. But it doesn't work in scale. Women are equally delinquent, like male. Because, when we dug data deeper, we realized that most of the women who take the money for their men. So it boils down to the same thing. So it is not about, the kind of borrowers or type of borrowers that you want to, have a bias about. It's very, very simple. You need to kind of put it out to a large number of borrowers without looking at name, caste, religion, all of that, and just spread it out. Even city concentration, people like some cities, some people say that, South people are a little more better than, North people. It's not true. Believe me, data is saying completely different. A lot of things, we are looking at data and seeing. So people say people living in, their own residence are better than the people who are living in rented accommodation. No. Not that you're going to go and get his house, bro. So there's no point, applying your mind with emotion. It's best to kind of apply with data. So there is lots and lots of data that we give to our lenders. And we use crowd intelligence, that data intelligence, to kind of build your, portfolio. And you suggest a lot of data and course correct your performance over a period of time. For example, you invested in Delhi, you invested in Bangalore, you've not invested much in Mumbai. And when you look at data, you get a normalized data of the platform, how entire platform is doing. You realize that Bombay is shared better than Delhi and Bangalore. So now it's time for you to start investing in Bangalore. So it gives you corrective data, cues to kind of go and make data corrections. Investment corrections. So also it helps you to create your portfolio in a better way. So there is also an auto invest option. So this is just to kind of cut that emotion part of it. So you kind of put the interest rates or the kind of interest that you want to earn or the kind of tenure that you want to kind of pick up. Basis that the money gets deployed to various borrowers. Now we use the crowd intelligence, people who have made the maximum amount of money intelligence to kind of build this allocation of money. Now if you've made money more than any of those 1,000 people who have made money, your name will go there and the last guy will come out of that list. So that's how it kind of self-learns itself. Okay, it's a self-learning. So I talked about this. There's a lot of data available for your course correction. Institution level is very simple. There is legal case that we do if the guy is not giving us money, and it's standard for us. It's as a process we run it, and one of the reasons that we run it as a process is because it's a revenue source for us. So unlike other banks and NBFCs who have to take this thing on their books. And sometimes people do ask us that I've just put 500 rupees, why are you putting so much of effort? And this thing is important because you don't want to send a signal saying that you can take money from an organization or a peer-to-peer lending company and just disappear and not pay back. We report it back to the bureau. We go after him. We go to the last mile in terms of putting a legal case and dragging him to the court. We do that as a process. We do. And we pick up 5% of whatever money that we recover. So that's the reason we do that. There is a revenue recognition for us.